Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney. We're counting down to Asia's major market opens.
I'm Annabelle Droulers in Hong Kong. The top stories this hour. Treasury yields falling from year-to-date highs ahead of the US inflation report. Bond traders now so bearish they risk getting squeezed on anything less than a red-hot reading.
New Zealand Central Bank is set to hold its key rate as the Institute of Economic Research finds business confidence is slumping.
And as Japan's Prime Minister prepares for his summit with President Biden, we talk trade and security with the US Ambassador, Rahm Emanuel.
And we're just about an hour away from major markets opening across the region. Take a look at how futures are setting up this session. We're seeing some mild upside when it comes to Sydney futures of about 0.3%, mostly skewing higher when it comes to broader Asia. We followed that S&P 500 a late day rebound to eventually close little change. So some mixed signalling going into the session here in Asia. Kiwi stocks are down by about 0.4%. We do have, of course, the RBNZ decision. Some of these indicators certainly looking a little bit more negative, but there is really just a focus on whether some of that guidance towards the inclination, possibly the pivot towards easing, might be moved forward in terms of timing. Nomura, for one, if you want to take a look at some of these RBNZ-related trades, they've exited their Aussie Kiwi long before that central bank decision, seeing that trading pair now coming near fair value. Nomura, Andrew Tyso saying that they're not confident that the RBNZ will be able to or will want to meet the more dovish pricing that we're seeing across markets. When it comes to Japan, Chicago Nikkei futures are looking upside about 0.25%. Bell.
Yeah, as you said, it was that sort of story in the US session. We did have that late day rebound in the US benchmark S&P 500 closing back above that 5,200 mark. Treasury yields as well, they climbed in the session. So you saw those 10-year yields dropping back from the highest levels of this year so far. Oil to note as well, we did see it dropping somewhat this morning, fairly steady here, but certainly it is that story more on the geopolitical angle of what we're tracking here. Gold as well, one to note, because it hit a fresh record high again intraday in the session. Interesting to note as well, given there's not really such a clear catalyst for gold in this sort of inflationary environment. But certainly the focus is very much on valuations at this point in time. Really, we're getting very much priced to perfection. Anything less from that we get in the eco data, any sort of geopolitical noise, it's something that could really, Heidi, lead to the risk of perhaps a substantial sort of sell-off.
Let's bring in Belle for some analysis. Garfield Reynolds, who leads our Markets Live coverage, Markets Live Asia coverage, I should say. You cover everything, let's face it. What are you watching most keenly? It feels like there's so much caution that it's sort of a flip of a coin, right, in terms of where we head next.
Yeah, well, I mean, I kind of suspect that we're likely to get some sort of a relief rally in risk assets in particular, because the market has gone through its moments of extreme fear when it comes to what the CPI could show. So, as you're flagging, you need a really, really hot print in order to upset the apple carts, and in particular equities. And that's also partly because of the Fed setup. We do have the Fed hawks saying that one of them was out again overnight, saying maybe just one cut, that's possible, or Kashkari, who doesn't vote, has been saying maybe 0 cuts. But meantime, as former Fed member Bullard reminded overnight, the kind of official central stance is 3 cuts are coming. No rush to cut, but they are going to cut. And we don't get a major speaker between now and when the Fed goes into its quiet period later on this week before the May meeting. So unless you're going to be willing to front run the Fed in the wake of this data and say, all right, even though the most important speakers have left us saying 3 cuts are still on the table, we're going to say they're not going to do 3 cuts because of the inflation data. So it needs to be really, really strong. And with what's gone on going into the data, the last couple of days, some of the moves we had in Treasury yields, the way the heat has come out of that, if we get something that's in line or slightly to the downside, you could get some relief rallies, especially, as I said, in equities. All equities need is kind of the status quo, and they're happy.
something or a group of people would be Japanese government officials that are going to be watching this very closely. If we do get something that's in line, perhaps a little bit weaker than expected, it could perhaps prompt a little bit of yen strength. But on the flip side, you've got that hotter than expected risk as well, and yen weakness and risks of intervention.
Well, I mean, at the moment, you have to think that perhaps the bigger risk for the yen is that it strengthens. We've had dollar yen go very close to 152, or even and that supposed line in the sand that's going to create intervention. And so far, even the level of jawboning hasn't really ramped up that much. And yet that line in the sand has held, and we've pulled back from it noticeably. There are a lot of yen bears out there, depending on which slices of the CFTC data you look at. The strongest bets against the yen on record. And those bets some of those are going to be looking a bit tired. Some of those, if people are sitting on gains, they're potentially looking to take profits, and they're all wary of, in either event, if you get a soft CPI print, that brings yields down, the yen strengthens, well, you might be forced out. If there's a pop that takes it above that 152 and then you get intervention, you're threatened with getting squeezed out. So there are going to be a lot of trigger-happy yen bears willing to pull out rapidly, so that they don't end up getting crushed in a squeeze if they all rush for the exits at the same time.
Guffey Reynolds, who leads our Markets Live Asia coverage there, ahead of, we can see lots of implications, of course, coming from that US CPI print. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can find that at Daybreak. It's also available on the mobile in the Bloomberg Anywhere app. You can customise your settings as well, so you just get the news on the industries and assets that you care about. Well, coming up, defence issues expecting to top the agenda during President Biden's meeting with Japanese Prime Minister Fumio Kishida. We'll be discussing those implications next with the US Ambassador to Tokyo, Rahm Emanuel. This is Bloomberg. Japanese Prime Minister Fumio Kishida will meet with President Biden later on Wednesday in the first official White House visit by a Japanese leader in nearly a decade. That will be followed by a three-way summit with the Philippines as the US seeks to counter China in the Indo-Pacific. Let's bring in Rahm Emanuel, who's the US Ambassador to Japan, who joins us live from the White House lawn. And it's a beautiful evening for you to be joining us. We appreciate your time as always, Ambassador. Give us your context, I guess, in terms of the implications of this visit, the timing. Why has this happened? As we've just mentioned, it hasn't happened in a long time. This is all in the context of countering the ambitions and the moves that we see from Beijing.
Well, two points I would add is that this comes at a historic moment for both countries as they change dramatically their kind of deterrence posture and position. Japan's changed in the last 2 years 5 separate policies that have been basically on the books for 70 years, from the size of the defense budget, the counter-strike capability in the defense area, normalizing and bringing the level of relationship with the ROK, the Republic of Korea, to a new, more solid strategic level. The United States also has made some fundamental changes, going from a hub-and-spoke system to a lattice multinational type of strategic architecture. And I kind of see this state visit, the fourth from a head of state in the region out of 5 that the president's done, is kind of putting a period at the end of one era that's defined as alliance protection and beginning to write the first chapter of the new era of alliance projection with Japan. And that's not just for the Indo-Pacific, but also as a key strategic partner in a global set of issues. The second thing, it's kind of bookend. The week started with Australia, the United States, Japan, and the Philippines doing naval and air exercises together in a new multinational effort, and have the ends the week with a historic first ever trilateral between the United States, Japan, and the Philippines head of state. That reflects and symbolizes the change in the United States approach It also symbolizes the kind of role that Japan's going to play as the constant in our relationships in the area. But it also symbolizes China's whole strategy is to isolate the Philippines, isolate Australia with their economic coercion, isolate Japan by not accepting their fish to be exported. Our strategy is to flip that script and make the isolated party China. They're the ones that are isolated in the South China Sea as it relates to the Philippines. They're the ones that are isolated when it comes to trying to use economic coercion to coerce Australia to change their posture. And they become the isolated party, which is why they throw in the towel on that effort. So that's how this state visit. It's been 9 years since the last Japanese prime minister has had a visit, but it comes at a critical juncture where the relationship will pivot into a new kind of posture and a new position.
I wanted to hone in, Ambassador. You've mentioned, of course, the first Trilateral summit with the Philippines. How far do you expect Japan to involve itself when it comes to these confrontations in the South China Sea, where, of course, these encounters tend to be more aggressive than what we see in the East China Sea?
Well, the whole goal is not to have a conflict. That's what credible deterrence is. And understanding that this is not China versus the Philippines, this is China trying to coerce the Philippines into changing their policy, on which the International Court in 2016 ruled was in favor of the Philippines, not China. And understanding that China needs to understand that the Philippines has some very, very important friends in the neighborhood, the United States, Japan, and Australia in this situation. And it's all about bringing a level of credibility to the deterrence, whether that's on the diplomatic front, the defense side, or the economic development side. And you will see that take place in real time. And since we announced the trilateral, you can see China's change in the behavior and their sense of that. In the same way that when the president hosted the president of Korea and the prime minister of Japan at Camp David in August, that was a major shift in the strategic sands and underpinnings in the region, because China's entire strategy is to keep Korea, Japan, and the United States isolated from each other, not on the same page, which is what was achieved at Camp David.
I'm interested, this sort of lattice-type structure, how strong that is, especially when you hear things like, for instance, South Korea is reported to be planning a three-way summit with China and Japan next month. So what's the sort of response, and what would the US be making of that?
Well, I know what happened since I was there at Camp David. We'll see. Obviously, we have this historic one, first time ever between the leaders of the Philippines, Japan, and the United States. But this lattice structure is a fundamental shift to the United States to a more multinational approach, whether it comes to military exercises, economic development, or whether it comes to diplomatic initiatives. And it replaces what was a siloed hub and spoke in a more integrated way, and it brings a level of not only deterrence, it reminds China, and there's two operative theories here. China's theory is, this is our neighborhood, you either get in line or you're going to get the treatment that the Philippines are getting, or any other country like Australia just recently experienced over the last 3 years. Our posture is we're a permanent Pacific power and presence, and you can bet long on the United States. And when you look at where we were 5 years ago, when you look at where we are today, China's on their back foot, and there's ever greater momentum behind the United States pledge. We're a permanent power, you can bet long, which is why countries are actually working together on every one of those kind of strategic levels, from development to deterrence to diplomacy, to work together in, not lockstep so much, but in coordination and cohesion with the United States' approach.
But then, what about China's approach and how it plays into it? And as I said, South Korea perhaps planning a three-way summit between China and Japan. So what are how can the US sort of counter that approach from Beijing as well, that could also be looking to have its own lattice-type structures in place?
Well, first of all, China has no treaty allies except for North Korea. Second of all, China is never going to win the award for the best neighbor policy. They've had 2 land conflicts already with India. They're having a constant kind of minor kinetic with the Philippines. They fired 5 missiles into Japan's EEZ. There's nobody in the neighborhood that China's not in some way claiming their real estate or having some economic or political confrontation with. So they can try a trilat, and great, Anything that deters China and understands there's consequences to try to use raw power rather than a rules-based system is a good thing. But I think China's reacting to the United States, not initiating where we're reacting. That the reason they want a Japan, Korea, China trilateral meeting is in a reaction to what the president achieved. They're trying to minimize that, which goes to underscore what I've said earlier, which is 5 years ago you would not have put that the initiative was on the United States. It's not a major gust of wind, but the wind is at our sails, where China, both at home and in the neighborhood, is on their back heel, and they're trying to make up for lost time.
What's the risk of US initiatives being undermined by election changes in the US itself, given we are approaching that vote in November and Donald Trump potentially inclined to overturn Biden policies if he wins?
Well, first and foremost, I would say that when it comes to kind of the area of the Indo-Pacific and China, we're strong because of our allies and alliances. What we're building here is starting to be put down in the roots of the institutions of whether it's Korea, Japan, the United States, Japan, and the Philippines, or whether it's the Quad, India, Australia, Japan, and the United States. That's being woven into the DNA of not only the strategy, but the institutions that help uphold those strategies or strategic areas. But I think we should be also honest. President Biden brings a level of commitment that all the other leaders respond to, that he values allies and the alliances that they're part of and sees them as core to America's strategy. So the advances over the last 3 years being built and being put into kind of wired into the DNA? Yes. Can a leader that doesn't believe in that start to roll the rock back down the hill? Could. But I think there's enough progress, and everybody in the institutions understands how this goes to the core strategic interest, where the United States doesn't want to be alone. They want to isolate China. That means our allies are key partners in that strategy.
From within Japan, in your role, are you getting more questions that perhaps suggest there is a rising degree of noise and uncertainty and concern about what the outcome might be post-November?
Well, I think you should, first of all, obviously I know a little about American politics. There's obviously people are watching American politics. And they're watching because it has a keen interest. There's a keen interest in who the president is and what their ideas are. Yeah, the people are interested in American politics because it has consequences. Elections have consequences. Of course they're interested, and they ask me about it. That doesn't mean they're not interested, like in this state visit, of doubling down on their partnership with the United States, because they know it's in their strategic interest, and it's in our strategic interest that they're aligned with us.
Ambassador, when we spoke to you back in May last year, you talked about the Micron deal with Japan really being a way to counter Chinese coercion in the tech and strategic space. Do you expect more to come out of PM Kishida's visit this time in terms of further investment to try and extend that lead that Japan and the US are trying to build?
Well, two things I would say. One is I went this morning. Microsoft announced a $3 billion investment in data and AI capacity and research in Japan. We also just announced Carnegie Mellon and Keio University in Japan will be doing research on AI, as will the University of Washington and Tsukuba University in Japan. There'll be $50 million, $110 million collectively by major corporations to back up that AI research in the 4 universities, 2 U.S., 2 Japan, building on what we did in Hiroshima with the University of Chicago and Tokyo University in the quantum computing space. We've put together around $260+ million just in the 2 areas of research of AI and quantum computing. That has a material economic benefit and material benefit to keeping the 2 countries ahead in some of the most important research areas that China's putting a ton of resources into. So there will be other type of commercial diplomacy. The Prime Minister will be going down to North Korea after his visit here at the White House, looking at Toyota's $13.9 billion EV investment in the United States and a Honda auto factory. For the last 4 years, Japan has been the #1 foreign direct investor in the United States, and we have been the #1 in Japan, and that's what's going to continue.
Ambassador, I'm curious about the U.S. opposition perhaps to Nippon Steel overtaking United States Steel and what that signifies to Japanese companies that are looking to make investments inside the U.S. Is there perhaps a need to think about the role that election year politics plays in investment strategies then?
Well, here's what I would say is, as I just said, for 4 years in a row, the United States and Japan are the #1 foreign investors in each other's respective countries. Japanese companies employ 1 million Americans, one of the largest in the world. Number two, 6 weeks ago, Mitsui Corporation from Japan received a $20 billion contract to replace all the cranes in all our ports because we don't trust the Chinese cranes that are there from a national security basis. Nothing says trusted ally more than a $20 billion contract to a Japanese company. And then I would remind everybody that in 2021, when there was an election in Japan, some foreign entities were looking at buying Toshiba, and Japan said for national security interests, that's not going to be permitted. So there's a context here. One is that the relationship is bigger, more significant than a single commercial transaction. And two, there have been things in both with Mitsui 6 weeks ago, as well as back in 2021 with Toshiba, that actually put this all in context. So it is, and the United States continues to be a target of investment from semiconductors from Japan, autos, EVs, food, pharmaceutical, financial services. And Japan continues to be a #1 market for the United States as an investor in Japanese economic growth and economic capacity. And that's going to continue, whether there's a disagreement on a single transaction.
All right, Ambassador, thanks so much for your time this evening. That was Rahm Emanuel, the U.S. Ambassador to Japan, joining us there from Washington. And we'll have plenty more to come on Daybreak Australia. This is Bloomberg.
Australia's government is planning to reform rules on corporate mergers in a move aimed at boosting competition and productivity. Paul Allen is here with the details. So is there a problem with the current system, and how does the changes address that?
Yeah, there kind of is. And just to give you a bit of context, for last year, for example, there were 1,400 mergers in Australia. On average, the ACCC, the competition regulator, scrutinises about 330. So a lot is slipping through the net here, and the Treasurer, Jim Chalmers, says, look, we don't even know if we're scrutinising the right 330, whether or not we're getting the mergers that have the potential to cause the greatest harm to competition. So this is the sort of thing these rules are being changed to address. Government analysis shows competitiveness has been declining in Australia. Market concentration has nearly doubled since 2010. So these reforms will mean that companies are going to have to tell the ACCC, the regulator, about mergers of a certain size. We don't know what size yet. Those thresholds are going to be put together with some consultation with industry. But it's going to have a focus on mergers that have the greatest competitiveness concern. They'll be more streamlined, more transparent, and mergers that are in the national interest will get fast-tracked, so they'll be dealt with over 30 days. We'll get a bit more detail on this later. Jim Chalmers will be giving a speech about this, but when the rules come into place, the reform should start by 2026.
Paul Allen here in Sydney with a look at some of these changes. We'll get more details as they come to us, but much more to come here on Daybreak Australia. This is Bloomberg.
Time for calls or morning calls ahead of the Asia trading day, and State Street is bucking market consensus that the Fed will keep interest rates high for longer. The asset manager thinks the central bank will cut by 50 basis points as soon as June, ahead of the US presidential election in November. It sees 150 basis points of cuts by year-end, which is about 2.5 times what markets are currently pricing. Meanwhile, Mohamed El-Erian is joining the growing ranks of those who expect the Fed to ease monetary policy less than its peers in the coming months. The Bloomberg opinion columnist says that's due to slowing growth and sharper disinflation in Europe. ECB policymakers will meet Thursday, and they're widely expected to telegraph a rate cut by June.
We may well see the ECB cut as often, if not more, than the Fed, which was unimaginable a few months ago. It is having a huge impact on relative pricing. between Europe and the US. And you do see that in the bond market, and you see it in the currency market.
And the Bank of Japan is said to be considering raising its inflation forecast at a policy meeting later this month after surprisingly strong results from annual wage negotiations. Meanwhile, Governor Kazuo Ueda has weighed in on the impact of a weak yen.
Monetary policy isn't conducted for the purposes of controlling exchange rates. Exchange rates may have an impact that can't be ignored on economic and price trends. In such a situation, there's a possibility of considering a monetary policy response. This is a general statement, though.
For more, let's bring in our Asia Economy and Government Senior Editor, Brian Fowler. And Brian, just talk us through sort of the ramifications for any sort of possible change to the inflation target on the outlook for policy and also, I guess, for the yen as well.
Yeah, well, it definitely would raise the likelihood of a second rate hike this year. Economists we've surveyed, 60% of them say they expect another rate hike by October. But the key is what's driving this. And as we just heard earlier, it's the wage hikes. And big wage hikes do two things. First, they put more money in the pockets of consumers, and that could lead to a revival of spending. Household spending has fallen in every month for a year now. But Governor Ueda has flagged the possibility or the expectation that personal spending will start to recover in coming months. And I think he's really referring to the wage hike effect with that. The other thing the wage hikes do is they give an incentive to companies to raise prices. Of course, their personnel costs go up for the wage hike, so they need to cover that to keep their margins healthy by raising prices. We've seen a lot of price hikes over the last year and a half, which we hadn't seen for decades during deflation, and we expect to see more of those this fiscal year.
Ueda also says that the BOJ would reduce stimulus further if the basic inflation rate nears 2%. So how much conviction is there in terms of not just getting there, but staying there, right? Are we sort of basically there?
Yeah, that's the key question. So inflation in Japan has been at or above the BOJ's target for 23 straight months. We get the March data next week. That should confirm 2 full years of being at or above that target. The problem is a lot of that price hikes, that's coming from temporary, transitory factors. So, for example, last month with the February data, we saw a big jump in the CPI that was due largely to base effects because a year ago, Kishida rolled out subsidies for utilities, which weighed on prices back then. That effect was removed, so prices, of course, jumped this year. The other thing is the weak yen, which has driven up import costs, and that is an unwelcome source of inflation. Ueda really wants to see demand-led inflation, so that's why he's putting so much faith in these wage increases, and that's why he's going to be spending so much time looking at how those filter through the economy as soon as those wage hikes actually start to take effect from around June.
And so how did the BOJ forecast compare with what we see from the private sector?
So far, BOJ and the private sector have been pretty close. BOJ's latest forecast for this fiscal year is 2.4%. That's what it's going to raise. We think we're going to see a higher forecast coming later this month. Private sector's been doing the same thing. BNP Paribas raised its inflation forecast for this fiscal year to 3% from a previous 2.2%. So that's also based on the wage increases that were so surprising. And we also saw SMBC Nikko raise its forecast to about 2.6% for this fiscal year. So I guess you could say that the BOJ is in line. It's going to be catching up with the private sector if it does go ahead and increase those forecasts this fiscal year.
Oh, Asia Economy and Government Senior Editor Brian Fowler there. Well, from the BOJ to the RBNZ, Bloomberg Economics expecting New Zealand Central Bank to hold its key rate at 5.5% at its meeting today, watching upside inflation risks and sluggish growth. Let's get more from Christina Leung, Deputy Chief Executive at the New Zealand Institute of Economic Research. And Christina, great to have you as always. And let me start off with your latest reports and some of the sampling that's done that suggests that there's quite a bit of downside when it comes to sentiment and confidence in the economy, right? Is that a good enough reason for the RBNZ to be considering possibly moving forward the timetable for easing?
So what our latest NZAR quarterly survey of business opinion shows is that there has been a decline in both headline business confidence and also activity when it comes to what firms are seeing in their own business. So with a net 24% of businesses feeling pessimistic about the general economic outlook ahead, and a net 23% of businesses reporting that they actually saw weaker activity in their own business. Now, in terms of what this all means for the Reserve Bank, we're seeing this weaker demand weigh on pricing and pressures, and that means that it does suggest a continued slowing in inflation pressures. It's important to remember that when the Reserve Bank started increasing interest rates from October 2021, that was in order to dampen demand, to take the heat out of the New Zealand economy, so that to reduce inflation pressures, to bring inflation back towards its 1 to 3% target band. So we are seeing the impact of those interest rate increases come through across the broader economy. For the Reserve Bank, it should feel more confident that things are on the right track in terms of a further slowing in inflation in the New Zealand economy.
Christina, I wanted to ask about the property sector in particular, because in your reports it shows that builders are pessimistic. On the other hand, if you take a look at the headline data, we're seeing gains actually when it comes to the property market year on year. So if we are seeing a return of demand, particularly driven by the rebound in migration, what is it that is making builders feel pessimistic about the broader sector?
So in our survey, as you say, while the pessimism was pervasive across the sectors, what we saw is that the building sector was particularly downbeat. We are seeing this increase, emerging signs of stronger demand when it comes to housing, partly supported by the strong migration-led population growth. However, when it comes to construction demand, certainly for the near term, this outlook is still pretty weak. And we see that particularly when the measure of architects, asking the architects in our quarterly survey of business opinion, that based on work in their own office, what their expectations are for that pipeline of construction work over the coming years. And what we're seeing is that architects are expecting a decline in the pipeline of across housing, commercial and government work, construction work over the coming years. We feel that a large part of that reflects the uncertainty that's in the economy. We're seeing the lagged impact of high interest rates continuing to dampen demand, access to finance. So overall, with that uncertainty, while we do expect that over the longer term, strong migration-led population growth will support housing and demand, and in turn flow through to that recovery in construction activity, particularly when it comes to house building activity, certainly right here, right now, that near-term outlook for construction is still looking very weak.
Yeah, I'm interested because the high levels of immigration we've seen in New Zealand has been one of the big inflationary pressures in New Zealand, but now we're hearing these calls for a sort of rebalancing on that outlook. So do you see that sort of trend could taper off?
So what we've seen is a surge in net migration since our international borders reopened. And while there are demand and increase that will support demand across a wide range of sectors, at the moment, what we're seeing is more the supply side impact on the economy more apparent. This is particularly so when we look at what's going on with labour supply. Over the past year, there's been a turnaround in terms of the net surge in net migration helping to alleviate labour shortages. From at the height of the COVID-19 pandemic period, where finding labour was a key concern for businesses, now we're seeing that shift to the drop in demand, the lack of demand, I should say, being that dominant concern for businesses. And in contrast to that, finding labour has now dropped away as being a constraint for businesses. And in fact, businesses are now reporting that it's actually easier to find both skilled and unskilled labour. And that's particularly the case for unskilled and semi-skilled labour.
So in that sort of context, do you think that there's space, even if the RBNZ is holding today as expected, a space for them to turn a little bit more dovish, perhaps in the language after the meeting?
Certainly what we're seeing is that with that weaker demand, it's flowing through to easing in cost and pricing pressures, and hence an easing in inflation pressures in the New Zealand economy. The key question for the Reserve Bank is whether this easing in inflation is at a pace, fast enough pace for them to be comfortable that annual CPI inflation will return back to its 1 to 3% inflation target band. We believe that the annual CPI inflation will return back to the target band in the second half of this year, which should give the Reserve Bank comfort to start cutting the OCR from May next year. Now, there's in terms of the balance of risks, we see that around the timing of that, the weakness in the latest NZIEL quarterly survey of business opinion does suggest that there is the risk of an earlier start to this cutting cycle.
When you take a look at the broad deterioration in confidence, how concerned are you that that will become embedded?
So certainly there are confidence that there is the risk of it being a self-fulfilling prophecy. The fact that at the moment what we're seeing is the impact, as I was saying, that intended impact of high interest rates and dampening demand, but also on top of that with uncertainty about the new government's priorities and in terms of spending priorities and cutbacks in the public sector, with those what that all means with that softening in the labour market, businesses are feeling more cautious about when it comes to hiring and investment. So when there is what we have seen over the history of business confidence survey is that when in times of uncertainty, you do tend to see businesses start to be more cautious, particularly when it comes to investment, and that has the risk to be a self-fulfilling prophecy in terms of reducing activity just because businesses are in that holding pattern and wait and see until there is more clarity about the outlook over the coming years.
Christina, thanks for your time. That was Christina Lung there, Deputy Chief Executive at the New Zealand Institute of Economic Research. And you can also turn to your Bloomberg for more on the RBNZ decision later. Go to TLive, go to get commentary and analysis from Bloomberg's expert editors. We'll have more ahead on Daybreak Australia. This is Bloomberg. South Koreans are voting for a new parliament in what's effectively a referendum on President Yoon's performance. The results will determine how much power Yoon has during his remaining 3 years in office. Let's get more now with our East Asia government editor, John Herskovitz, joining us from Seoul. And John, what's at stake here really for President Yoon in the election?
As you said before, what we're looking at is what will happen for the remainder of Yoon's 3 years in office. Right now, the opposition Democratic Party bloc, the Progressive Bloc, has the majority. If Yoon's Conservative People Party Power bloc can take control, he can push through his pro-business agenda, tax cuts, taking on labor unions, deregulation. So it really determines what the course of his administration is going to be for his remaining 3 years in office.
What are some of the key numbers that we need to watch for?
Of course, this is a 300-member unicameral parliament. So the big number is 150, 151, who can get the majority. The next number to look out for is 180. If the Democratic Party, the Progressive Bloc, can get to that level, they can block filibusters, really take control of the body. The big number is 200. If the opposition Democratic Party reaches that, they have the power to override vetoes and even impeach the president. So these are the numbers to look at as the results start coming in from about 6:30 tonight local time.
And John, ahead of this vote, one of the things we've been talking about is the doctors' strike, and perhaps that could be something that provides a bit of a boost to President Yoon. But what else is on the mind of voters going into this?
The big issues are really pocketbook issues. Inflation that's been on the rise really hit the price of fruits and vegetables. Housing prices have been steadily rising over the years. So people are just are worried about their finances, and they are going to the polls with this being one of the big things in mind. The doctor strike has been bubbling on for nearly 2 months now, so that's also weighs on the mind. Strangely, North Korea has been a little bit quiet this election, so we haven't seen much so far from Kim Jong-un's regime going into the polls.
Our East Asia government editor John Herskovich there in Seoul. Well, the latest geopolitical headlines that we're tracking this hour, in Russia and China say they've agreed to start a dialogue on Eurasian security with the aim of double counteracting the European Atlantic alliance led by the United States. Russia's Foreign Minister Sergei Lavrov told a news conference in Beijing that the two nations would begin a dialogue and seek other like-minded countries to join. Beijing and Moscow have intensified their partnership since the invasion of Ukraine. China is sending its highest-level delegation to North Korea in nearly 5 years. The third-ranking member of the Politburo, Zhao Liji, will lead the 3-day trip starting on Thursday. China has long been North Korea's biggest benefactor, but the US says Kim Jong-un's regime is now receiving massive amounts of aid from Russia in exchange for transfers of weapons for the war on Ukraine. Coming up, a bull run in Japanese stocks boosting the nation's weight on an Asian benchmark versus its Chinese peers. We get the details next. This is Bloomberg. All right, take a look at the latest data just crossing the Bloomberg when it comes to Japan PPI. March producer prices rising 0.2% on month. That is slightly weaker than expectations of 0.3%. Producer prices year on year seeing a rise of 0.8%, which is bang in line with expectations there. We're also getting some bank lending numbers coming through, seeing a rise of 3.6% year on year, stripping out trusts, and 3.2% year on year, including trusts there. Well, the weight of Japanese equities on the MSCI's Asia Pacific Index has hit a 5-year high against Chinese peers. It underscores a shift in investors' preferences between the two giant markets. Let's bring our senior Asia stocks reporter Hideyuki Sano in Tokyo. And Hide, we've kind of seen this anecdotally, right? And certainly in a lot of the flows away from Chinese equities and into these darling markets like Japan and also the likes of India. How big is that gap now?
Hi, Heidi. Yes, the gap is becoming very large. It's the largest in over 6 years. So at the moment, Japanese market accounts for about 35% of Asia Pacific Index, while China accounts for only 15%. Now, if you look back just 3 years ago, I mean, the gap was only 5 percentage points, and I guess most people in the market most thought that it would be inevitable for China to overtake Japan, given that China has the economy that's 3 times larger than Japan's. But since then, of course, as we all know, the Chinese shares have slumped while Japanese stocks have found renewed momentum. So at the moment, Japan seems to be Japanese shares are favorite for many international investors. But from now on, I guess that it really depends on how long Japanese market can sustain the current momentum.
How long can this sort of last, though, if you've got that weighting that's so high now, more than a third of the Asia Pacific Index, versus investors sort of starting to dip their toes back into Chinese equities?
Yeah, I mean, we're starting to hear some investors might shift back to China now that there's a sign that at least Chinese policymakers seem to be much more serious about trying to boost the economy and the stock markets. And also, some people are starting to worry that the Japanese market might get ahead of itself in terms of expecting changing corporate behaviors in Japan. I mean, the Tokyo Stock Exchange has been doing this campaign on Japanese companies to take stock prices seriously and boost capital efficiency, etc. And many Japanese companies are expected to announce their plans in coming weeks. But it is easy to come up with a plan, but actually delivering what you have promised is much harder job. So you could say that some investors might think it's time to take some money off Japanese stocks, but we'll have to see. In any case, the next few weeks will be very interesting to see how Japanese companies will announce their thinking about capital efficiency and rewarding more to shareholders.
Yeah, and that risk of conservative guidance going forward, the risk of maybe a strengthening yen and you know, and again, perhaps some money going back into China. Is that why we've seen the Nikkei 225 kind of range bound between that 38,000 and 41,000 window?
Yeah, I think so, exactly. I mean, of course, one thing to consider is that we're going to have an earnings season, so most investors are now waiting for the earning results. And also the yen is another factor. At the moment, the dollar yen is trading at the near 152. It's basically the highest level for the dollar in many years, and many investors are expecting that Japanese authorities might intervene if the yen weakens further, and that could complicate the short-term outlook for the stock markets as well. So I think at the moment there's not many incentives for any investors to take a large position.
That was our senior Asia stock reporter Hideyuki Sano there in Tokyo. And time to check some of the stocks to watch when Japan trading starts in just a few moments. Keep an eye on the chip makers in particular, because Microsoft says it's investing almost $3 billion over the next 2 years to boost its AI capacity in the country. So Advantest, Nikon, Tokyo Electron, they're some of the names that are going to be in the spotlight.